Hi guys, welcome back to my channel. I'm Kata, the model investor. Got my glasses on today. No laughing, please. Anyway, I wanted to do a post. Obviously, right now we're in a very uncertain time. We have the stock market bottomed out. We have coronavirus to worry about. Talks of a recession. All this panic and worry out there. And I was keeping my cool pretty good. And then the other morning I woke up with this kind of panicked feeling, like I was running a lot of worst case scenarios in my mind, right? So I had a modeling job cancel, and just slowly the effects of the coronavirus are starting to feel more real. And of course I was like, oh no, I have all these mortgages I need to pay each month. What if my tenants stop paying? Just these general fears that I know a lot of real estate investors are having at the moment. And so that, a couple of days ago I woke up with this panicked feeling, and then I read an article. Brian Murray, who's one of my favorite authors, and he's a very well respected real estate investor, wrote an article not related to the coronavirus, but just like now is a good time to really analyze your portfolio, your properties, and look at what kind of debt you're carrying and just run some scenarios and see what kind of position you're in. And, I'm pretty on top of my debt and everything, but this really gave me a lot of comfort to look really deep into what I owed on each property, etc., etc. So I think it's times like this. So many investors assess their level of risk by calculating the equity in their properties against what they owe on them. And that's fine, but in uncertain times like this, equity is very subjective. And it can be gone in a second. A market can turn, there could be a crash. Anything can happen, right? And so equity is like, I think Brian said in the article, like it evaporates like water on a hot pavement. Very real, but I don't think right now that's a good way to analyze what kind of position we're in right now. So I want to talk about debt service coverage. So that is key right now. So we want to look at cash flow. Cash flow, of course, rent's coming from tenants minus expenses each month. So we want to look at how much of a cushion you have above your debt service. So how big is your cushion? I'm sitting on now. But we can measure the size of our cushions by a simple calculation called debt service coverage ratio. So DSCR, I'll put a thing up here. And that's calculated by dividing your net operating income against your debt service. So I will also make a little note here so you can do that if you don't know how to do that already. So say you have a net operating income a year of 100,000, right, across your portfolio, and your mortgage payments in total come to 50,000. So that would be a 2.0 ratio. So that's actually pretty good because it means you're covering your mortgages twice with your cash flow. Banks, I know, like to look at it. I think it's about 1.3 to 1.5 is like a good safe coverage. Anything below 1.3 starts to get a little seedy, especially in times like these. Of course, with fears of a recession, people are like, all right, so what if we had to drop the rents? Or I think in my case, I'm more worried about a couple of cash-paying tenants right now not being able to pay. So my calculated vacancy rate might feel like it's a lot higher. But luckily, And thank goodness I have a large percentage of my tenants are government funded. So say, for example, you had to cut your rental income, your rents in half. Will you still be able to make your debt payments on time? I think that's kind of the thing. Like worst case scenario, okay, we're not making any money the next couple of months or whatever, tenants are having a hard time paying, or we have to drop rents. Are we going to be able to make our mortgage payments on time? That's what we need to look at. And another point also I had written down to talk about, have a look at your mortgage rates. Now is a good time to look at, do you have balloons coming up? What kind of risk are you with high interest rates? Obviously the rates are very low right now. I know a lot of people were refinancing, pulling some cash out, dropping the rate, but I decided not to do that. I'd rather just sit on the equity in the meantime. Also the cost of refinancing and stuff. I haven't held a lot of properties. I mean, I've only been investing for 3 years, so my properties haven't gone up and tripled in value or something to make that worth it. But I did have a really close look at, I kind of put a spread, created a spreadsheet, looked at all my interest rates, when they were due. I have a couple of commercial loans that have a floating rate after 5 years. When's that 5 year up? I have a seller finance deal that has a balloon. When will that balloon be, will need to be paid? And just kind of getting a real handle on that, and I kind of really dug deep into that to make sure that I wasn't going to be getting any surprises. Because, the years tick by quite quickly, and all of a sudden you have a balloon payment, or the rate's about to float and adjust, and that's a little scary. So, although not right now, it would have been a nice time. So yeah, I just wanted to touch base on that stuff. Basically, limiting your exposure to risk, or just, analyzing what your risk exposure is right now, and just being on top of that. Most real estate investors I know are quite heavily leveraged. That's part of the strategy that we use. Obviously, it would be nice not to have that kind of weight to worry about, but it's just part of it. We'll get through it. It's just we don't need to panic, but just plan accordingly and make sure in times like these you're not too over leveraged. Have those reserves stocked up if you can, and we'll get through it. But cash flow is definitely key. Brian Murray mentioned in the article, he's like, cash flow is really where the rubber meets the road in situations like this. So we can't count on appreciation. Don't count on the equity that you have in the properties, because that could vanish. Things can change quickly. As with, 3 months ago, I felt quite differently. I was making a very aggressive push to buy several properties and really push my leverage. But now I'm starting to feel like I need to pull back a little bit just to be safe. Because everything's just kind of so up in the air and uncertain right now. So just stay on top of your debt and really get to know what's happening with each property and make sure that you're not missing anything. And use that calculation, debt service coverage ratio. It's a good one. But hopefully we will talk next week. Well, we won't talk, but I'll talk and you'll listen. And maybe we'll have some better news, or I don't know. But everyone should stay safe out there and stay well, and hang in there, and happy investing. Don't worry, don't get down. There's going to be some good deals coming up soon. Hoping to close on something next week that's been taking a minute. So I will keep you posted. All right, guys. Talk to you soon. Bye.